Morning, everyone, and thank you very much for joining me. This is the morning market review. It's Friday. It's the 8th of September. My name is Russell Shaw. I'm a senior market specialist at FXCM, and I'd like to just draw your attention to my email address, rshaw@fxcm.com. And of course, if you'd like to correspond, just send an email to that address and I'll answer as soon as I can. I'm just going to go ahead and bring up our disclaimers, and we'll start off with a high risk investment warning. I'll just keep this on screen for a few moments. All right, here is our market commentaries disclaimer. I'll again leave this on screen for a few moments for you to read. Good morning, James. Pleasure to have you on the webinar. Thank you for signing in. Good morning, Mia. Welcome. Thank you, everyone, for signing in this morning. And our references, MarketScope and TradingView. The methodology that we use, well, we'll start off with the real rate just to see what's happening here. It is interesting. It's very interesting. The real rate does look to be curling over here. Let me just put in an ellipse just to mark where it's coming in, just over here. Okay, so you can see that there does seem to be a hinge in terms of the trend. And take a look at the RSI coming in and sort of moving towards that 50 area. The real rate is a key driver of the US dollar. So the fact that we're seeing that real rate having a corrective or a pullback effect today, perhaps something that we need to consider in terms of looking at the US dollar. US dollar has been very strong. It's starting to make headlines now. We've been on top of it for quite a while now, but the idea is that I think the pullback in the real rate here may just be something we want to keep on top of. The idea, of course, is if we go through to a longer term chart, let's just get rid of the ellipses. If we go through to the longer term chart, we're still very much in bullish mode here, and it's still very much the key driver behind the US dollar. What effectively is driving the real rate? Okay, why is the real rate elevated? It's because the US is doing much better economically than the rest of the world. The rest of the world has contractionary data, whereas we're seeing expansionary data out of the US, and that's really what's behind the strength in the US dollar. And so does this mark the end of the bull run? No, I don't think so, Kim. Markets never move in a straight line. We've got to acknowledge that right at the beginning, that markets never move in a straight line. They're going to ebb and flow. They're going to zigzag. That's in the fixed income market, as well as the Forex market, as well as the stock market. When we get some sort of pullback, it's usually linked to buying and selling activity. Either somebody's taking profits off of the table, but the idea here is no, we don't say we're at the end until we have proof that we're at the end. And the idea here is we'll never know until after the fact. Now that sounds quite harsh. Unfortunately, let's just bring up Microsoft Paint. It's just something that we're going to have to accept. We will just think about it in terms of our personal trades. We'll never get in at the bottom. We'll never get in at the top. And the question is why? Because we're only going to know after the fact if the trend is up. We need 4 points, right? 1, 2, 3. Only when we've got the 4 points, it's really when we take our point 2, do we know that we've got an uptrend? Okay. So when we're looking at a downtrend, we only know after the fact that we've got a downtrend. Okay. So we'll go here and we'll put in 1, 2, 3, 4. It's going to evolve over time. It's not going to be something that we are going to just make a snap decision of. So that's the reason. We're only going to know after the fact. So we don't want to predict. What we're seeing here on the daily chart, okay, what we're seeing on the daily chart is that there is some sort of pullback. And of course, that's probably linked to some sort of fixed income activity. But what time frame? The higher the time frame, the more powerful. So you can go through to the monthly, and you can quite clearly see that the real rate is in bull mode. It's quite clearly in bull mode. Interestingly, getting perhaps a little bit close to overbought. Okay, so we'll discuss that for a moment. But the higher the time frame, the more powerful. And generally, if we see a cross of the 5 month below the 10 month, that's probably meaningful. And then what I like to do is I'll go down to the weekly chart and I'll see if I can match the peaks and troughs, I beg your pardon, on the the daily chart. Certainly, I think too close to the price action. That's the technicals, Kim. Also, remember, we want to interlock those with the fundamentals. The real rate here is not reversing at the moment. The data in the US is too strong. Okay, we may have some sort of pullback, but I think that's as far as it goes. Does that help at all? Just let me know. What could possibly be affecting the ebbs and flows, the zigzags? Well, there are market participants in the fixed income market. Let's just say you wanted to buy a 10-year bond. Okay, it's obviously it's quite restrictive for individuals to buy, but let's say you wanted to buy a bond fund, or you wanted to buy a bond via an ETF, okay, exchange traded fund. There is something called IEF. Okay, IEF is the iShares 7 to 10 year treasury bond. It's looking not at yield. It's not looking at yield. It's looking at price. So the idea here is, let's go through to the daily chart here. You may be of the opinion that the 7 to 10 year is often good value for money because it's been so beat down. You may be thinking, how much lower can it go? This is not advice. This is just purely what happens in the market is that sometimes value investors, fixed income value investors, would probably try to get in on a lower bond price, pushing the bond price up, pulling the yield down. Take a look at this on a weekly chart. It's really been beat down. Okay, so and that's there's a concept in the market called the pain trade. What's the pain trade? Bonds could be a pain trade now. In other words, you think that you're buying value, but the yields just keep pushing higher. And if the yields just keep pushing higher, bond prices just keep pushing lower. So you think you're getting good value, Okay, so whoever bought over here, let me just fix this up. I don't want the background, I don't want to extend it, and I want the border. There we go. One more border. Let's just make sure there's color. If you were buying bonds at this level or this level because you thought they were representing good value, well, if you bought here, you're only at break even. If you bought here, you're in loss. You're experiencing a certain amount of pain. So what's the pain trade now? Possibly bonds, right? Does everybody understand the pricing mechanism? It's based on the demand and supply, and demand and supply changes. It's a dynamic. It's not a static. So that's what's happening at the moment. Let's go through to our US dollar, and the trend on the US dollar is up. We've got a higher trough followed by higher peak. Okay. Mia's saying she doesn't understand. Mia, do you understand that yields are inverse to prices? Does that make sense to you? Inverses. So as the price of bonds move, the yields are going to move as well. If the price of bonds go up, okay, all right. Just send me an email. I think there's a video that we've done on it previously. If you just send me an email, I'll send through the bond video to you. Okay. All right. Higher trough followed by a higher peak. It's an uptrend here, Kim. It's an uptrend here. We did note that the higher trough is just a 1 week price action, quite odd. But what we can do here is we can take a look at it in terms of a 30-week moving average as well. And what we can look at is if price is above the 30-week average, and then we want to add an extra filter. Which way is the moving average pointing? Well, it's pointing up. So we're using the direction of the moving average as a filter as well. So the fact that it's pointing up, okay, and that the US dollar is above the 30-week exponential moving average, well, that seems to suggest bullish support. Remember what we did yesterday? We went through to the monthly chart on the US dollar, and we've actually got here on the monthly chart we do have a breakout. Okay, we're at resistance, but we do have a breakout here. It's taken out the green horizontal, so the dollar is looking exceptionally strong at the moment. All right, I'm just going to wait a few moments just to see if here we go. So can you see we're pushing up here? The dollar certainly not looking weak at the moment. So if it's not looking weak at the moment, it's something that we've got to acknowledge. And what are we acknowledging? We're acknowledging a strong dollar. If the dollar is strong, okay, then what did we say yesterday? Yesterday, we said that there's probably going to be headwinds on the other majors, likely see pressure on the euro, US dollar, likely see pressure on pound, US dollar, etc. So the fact of the matter is the dollar is still having huge influence. All right. We'll just go through to trading view. And what we'll do is we'll look at the euro US dollar. Okay, and what you can see is that there is a bearish cross with the EMAs, in that the RSI is below 50. Okay, so there does seem to be some sort of pressure to the downside on the euro. At the same time, let's just take a look at the US dollar. It's a dual analysis. Okay, so we take a look at, and here we can see there's a bullish cross on the EMAs, and the RSI is above 50. Okay, so again, dollar is strong, acting as a headwind against the euro US dollar. Let's take a look at pound US dollar. Kim asking if we get stopped out on the euro US dollar because we trailed our stop. Was this an incorrect move to trail the stop? No, I don't think it would be an incorrect move. You trade according to a trading plan. So the trading plan's got to be tried and tested so that you're confident and you understand that there are going to be whipsaws as well. But the idea is that you need to trail your stop because you effectively need to lock in profits. You've got to protect your position. Okay. Pound US dollar. Bearish cross to the downside, and you've got the RSI below 50. Okay, so we've got the theme here: bullish cross on US dollar, bearish cross on euro US dollar, bearish cross on pound US dollar. Let's just take a look at two others. Let's take a look at Aussie US dollar, and let's take a look at US dollar Canadian. Okay, we're in bear mode on the Aussie. It's you can see you've got this crossover to the downside. Let me take these old labels out, and you can see that the RSI is below 50. Okay, again, what are we looking at here? We're looking at US dollar strength. We're looking at headwinds against the majors. Let's take a look at US dollar Canadian. All right, US dollar Canadian showing US dollar strength, bullish cross to the upside, RSI above 50. Just want to go to the euro US dollar, and let's just zoom into the hourly, and I'll just see if I can see where we could possibly have been stopped out on the euro US dollar. So the euro US dollar is pushing down. It's in zone 3. Okay, and assuming that you took the signal over here, you would have been stopped out somewhere around the central pivot. Okay, now we're looking at the next setup of resistance, R1 resistance. Okay, it looks like it's acting as a key area to monitor. Is there going to be a bearish crossover on the EMAs? We've already seen a bearish crossover on the stochastic. The resistance area here looks fairly sturdy. Okay, so again, the fact of the matter is we're looking for the hourly to sync up with the daily to sync up with the weekly. But the idea here is don't not use a stop loss. You have to use a stop loss. Okay, you have to manage the risks. Kim, that makes sense. Just let me know. Let's take a look at gold just to see how gold's, and then we'll take a look at the DAX. Okay, gold. We've take a look at gold. You see this resistance area, the support area here, and if we take a look at the daily, we are in zone 2. Take a look at DAX as well. And you'll see the gold chart and the DAX chart are very similar. Take a look, just like there's that support on gold, there's support here on the DAX, but we're still in zone 2. So even when we see there are weekly support areas which look quite relevant, we're still in no man's land on the dailies for gold and DAX. Why are we still in no man's land? It's because the dollar is so strong. That's the theme that's running the market at the moment. That's what should be at forefront of our mind as traders. Okay. So I don't know where you set the stop, Kim. It may not be too tight. Okay. Let's just remember one last thing for today is that when you trade, most times you're going to be stuck in the middle. What do I mean stuck in the middle? Well, you're going to be stuck in the middle of a distribution curve most times. Okay. In fact, trading has a slight negative skew to it, but it doesn't matter. Well, just the positive skew. We've looked at this many times. Most of the time, you're going to be stopped out for a small gain, or you're going to be stopped out for a small loss. Okay, but every once in a while, 13% of the time, you're going to have a really good run. You're going to go past that first standard deviation, and remember, you've got to get past this first standard deviation on the right side, and use stop losses to completely cut off the left side of the tail. But 34% of the time, 34% of the time, you're going to be stopped out for a small loss. 34% of the time, you're going to be stopped out for a small gain. 13% of the time, you're going to get a good run. And I think this is 0.2%. Okay, 0.2%, you're going to get a really good run. You'll make a really good trade 0.2% of the time. So it doesn't really necessarily mean that you've got a stop that's too tight, Kim. It just may be that you are trading within the first standard deviations. Okay, just understand sort of the distribution curve. All right. Any other questions? Any other questions? All right, nothing coming through. So let's wrap up here, and I'll wish you guys a good day ahead, a good weekend ahead, and we shall chat on Monday. Thanks very much, guys. Thanks, James. Have a great weekend yourself. Cheers, guys.